US Treasury bonds, the so-called safest assets in the world, just got downgraded again. And nobody's talking about what it actually means. My name is Joe Brown, and I run Heresy Financial, where we publish investment research and education for active investors. But before that, I was a stockbroker for years. I worked with the top 1%, many of whom were consistently invested in the cookie cutter 60-40 stock bond portfolio. And if that's you, you're gonna wanna pay attention, because this right here could impact your returns for decades. So here's what happened. You are looking right now at the Moody's ratings downgrade on US government debt. You can see that the rating was dropped down from AAA to AA1. You can see also, while they did drop the rating to AA1, they also changed the outlook to stable from negative. This is a 1-notch downgrade on their 21-notch rating scale. If you scroll down, you can see their ratings rationale on why they downgraded to AA1. In their own words, for over a decade, US federal debt has risen sharply due to continuous fiscal deficits. During that time, federal spending has increased while tax cuts have reduced government revenues. As both deficits and the debt have grown and interest rates have risen, interest payments on government debt have increased markedly. In other words, the amount of money the US government borrows every year has been growing. Now, that has been from a combination of lower taxes at some times, but also way more spending every single year. The second reason for the downgrade was because interest rates have been rising, which means on the entire pile of the national debt, just the cost of servicing the national debt has been going higher and higher and higher. Interest payments on the national debt by themselves are soon going to be the largest expense in the entire federal budget. And so because the combination of these reasons, Moody's has now downgraded US government debt, which means they're saying the likelihood of default is slightly higher than it was before. But guess what? They're missing the point. Risk of default is not the risk that you should be paying attention to when looking at US government debt. Don't get me wrong. It is kind of a slight risk, but not really. As modern monetary theorists love to point out, you cannot be forced to default on debt if you borrow in a currency you can print, because you can print an infinite amount of currency in order to pay back your debt. However, as modern monetary theorists love to ignore, the number of dollars has nothing to do with the purchasing power of those dollars. Let me give you an example to illustrate what I'm talking about here. Let's say tomorrow the government decides, hey, we're gonna have the Federal Reserve print up $1 billion per person. We're gonna deposit $1 billion in every single person's checking account. I think anybody with half a brain cell would realize that immediately we would have hyperinflation. The dollar would become virtually worthless overnight. Prices would immediately rocket upwards in order to compensate for all the new money floating around in the system and being spent. The price of everyday household items like milk or a gallon of gas would cost millions to maybe even hundreds of millions of dollars. Now, obviously, something like that is not going to happen anytime soon. In our reality, things are a lot more incremental. They are printing money. It's not $1 billion for every person, but they are printing money fairly rapidly. And as they print money for their spending and to pay their debt, dollars become worth less. Not worthless, just worth less, because those new dollars have purchasing power only as a result of pulling it away from all existing dollars. This means that when you are a bondholder and you hold US government debt like a 10-year treasury and you get paid 4.5% every single year until maturity, even though that is a positive nominal rate, you're getting 4.5% back on your money. Most of the time throughout history, it is a negative real rate, which means after adjusting for inflation, you're still losing purchasing power. In other words, your dollars in your bank account might go from $100 to $105, but over that same amount of time, the stuff that used to cost $100 now costs $110. Yes, your dollars went up, but your purchasing power went down, which means that in a best case scenario, when you loan money to the US government, especially for the long term, you are losing a little bit of money. And as Moody's has recently pointed out, the risk of a worst case scenario in which they just decide to default just became slightly higher. But wait, there's more. In like a reverse infomercial here, that's not even the worst part, because it's not just US government bonds that are affected by this. When you look at a bond market ETF like BND from Vanguard, this is a fund that takes your money and buys corporate bonds with this, which means your money, instead of getting lent to like the US government by buying a treasury, it's getting lent to large corporations. They pay you interest along the way, and then when the bond matures, they pay you back your principal. Funds like BND take your money and spread it out over many, many bonds. And you can see the performance of this has been pretty terrible. That's because as interest rates go up, the value of those bonds go down, which means if you have to exit those bonds prior to maturity, you lose money. The interest you collected along the way was not enough to make up for it. And even if you do decide to hold on to them until maturity, corporate bonds are still subject to inflation, just like treasuries are. Yes, typically corporate bonds will have a little bit of a higher interest rate to accommodate for the little bit higher likelihood of default. But the dollars you get back are still having their purchasing power sucked away from them by inflation, just like all dollars are. And in fact, as the national debt pile grows, this problem gets worse and worse and worse, because they are forced to print more and more money all along the way just to keep making the payments. So even when you loan money to a corporation by buying a corporate bond, you loan $100 and you might get $106 back. But again, if the cost of everything else went from 100 to 110, again, you're still losing, which means the 60-40 stock bond portfolio is dead. This portfolio grew in popularity because there was a 40-year bond bull market as interest rates dropped from 1980 to 2020, which means every investment advisor still alive and working today has only existed during a time period in which bonds go up over time from interest rates dropping. But that ended in 2020, and we are now in a period of time that will look much more like 1940 through 1980 than it will the last 40 years. Because from 1940 through 1980, the government had to do exactly what they have to do today, which is deleverage. So they print money to pay their debt. That means the real interest rate after adjusting for inflation is negative. Not only that, but the diversification that bonds are supposed to provide for you in your portfolio, it's almost gone today. Increasingly lately, the correlation between stocks and bonds is growing, which means that they fall together and rise together. They fall together, they rise together. It used to be common knowledge that if your stocks are going down, your bonds would go up. And if your bonds are going down, your stocks would go up, providing you a hedge against that volatility in your account. And today, because so much money is invested in both stocks and bonds, when people are selling, they're selling both. And when they're buying both, which means a correlation is high and you no longer have that protection against volatility. It is more and more a fiction of the past. Now, I've put together what I believe is the solution to this problem, and it's called the Hedged Hypergrowth Portfolio Blueprint. With this program, I walk you through exactly what you need to do to protect your portfolio from both inflation and crashes, but even more importantly, maintain exposure to massive upside potential. In other words, I've created a step-by-step plan that anyone can follow so that your account can weather any storm and you can find hyper growth assets to invest in. If that sounds like something you're interested in, the link is in the description below. As always, thank you so much for watching. Have a great day.